In today's Thursday edition of the Tech Stocks Daily podcast, we're diving headfirst into the whirlwind of tech on NASDAQ. Get ready for an electrifying ride through Tesla's strategic turbulence and stock pressures, Google's controversy over Project Nimbus sparking employee protests, Infosys' surprising workforce shift amidst the tech evolution, and Apple's resilience in the face of mounting challenges and fierce competition from Huawei. We're unpacking how these giants are navigating the choppy waters of today's market sentiment, from investor skepticism to strategic recalibrations. Hold on to your seats. This episode is packed with insights that are sure to spark lively debates and deeper reflections on the future of tech. In today's tech landscape, where electric vehicles represent the vanguard of automotive innovation, Tesla Inc. has cemented its place as a trailblazer, disrupting the status quo. However, recent developments have placed Tesla under a magnifying glass, revealing a slew of challenges and strategic shifts that could define its trajectory in an increasingly competitive sector. Tesla, renowned for its pioneering electric vehicles and ambitious vision for autonomous driving, has encountered turbulence, manifested in its stock's performance and strategic decisions that hint at a future fraught with both opportunity and obstacles. Firstly, Tesla's stock has been under significant pressure, illustrating investor concerns over the company's direction amidst a broader EV market slowdown. Recently, Tesla shares tumbled, driven by concerns over the company's strategic pivot away from introducing a more affordable Model 2 EV, favoring a focus on the development of autonomous vehicles, particularly robotaxis. This shift signifies a substantial alteration in Tesla's path to potentially dominate the automotive sector, emphasizing software and services over broader market penetration with more accessible vehicle models. Deutsche Bank's downgrade of Tesla's stock to a hold rating amplifies the unease, pointing to looming challenges in cracking the complexities of full driverless autonomy, a technological ambition fraught with regulatory, operational, and competitive hurdles. The bank's analysis underscores a pivotal concern. Delaying or potentially abandoning the launch of the anticipated Model 2 could strain Tesla's profitability and volume growth, encumbering its ability to leverage its EV and cost advantage amidst fierce market competition. Tesla's recent financial disclosures reveal a company at a crossroads. Faced with the first year-over-year decline in quarterly vehicle deliveries since 2020, Tesla's strategic recalibration appears as an adaptive measure to a market embracing electrification at a dizzying pace. Yet the company's endeavors in autonomous driving and advanced AI introduce a long-term vision that could redefine urban mobility and automotive functionality. Nonetheless, this forward-looking strategy does not mask the immediate challenges Tesla confronts. The global slowdown in EV growth, exacerbated by economic headwinds and supply chain constraints, paints a stark backdrop to the company's ambitious efforts. Furthermore, the layoffs shedding over 10% of Tesla's workforce, as revealed in CEO Elon Musk's internal communications, stress a sharp pivot toward efficiency and cost management. These steps hint at a broader industry trend where EV manufacturers must navigate a delicate balance between innovation, market expansion, and financial sustainability. The skepticism from industry observers and analysts, spotlighted by Morgan Stanley's acknowledgement of an impending EV recession, suggests that Tesla's journey ahead is far from straightforward. Despite this, the investment firm's continued overweight rating on Tesla's stock, predicated on its potential as an AI powerhouse, encapsulates the complex narrative surrounding Tesla, a blend of immediate hurdles and prospective techno-industrial revolutions. Today, Google finds itself at the center of a whirlwind of critique, attention, and heated discussions, fueled by a series of protests directly tied to employee dissatisfaction and broader ethical concerns over its business contracts. The nucleus of this maelstrom is Google's involvement with Project Nimbus, a $1.2 billion contract to supply cloud computing and artificial intelligence services to the Israeli government and military. This situation has triggered a series of protests, culminating in Google firing 28 employees who were directly involved in these demonstrations. Before delving into the ramifications of these protests and terminations, it's crucial to understand the backdrop of Project Nimbus. Signed in 2021, this contract is a cornerstone of concern amongst Google workers and activists who argue that the technology provided could be harnessed for military purposes, including surveillance and operations in conflict zones. These concerns are not only ethical, but deeply personal, affecting employees whose backgrounds put them at odds with the applications of the technology they helped develop. The protests, sprawling across office locales in New York and Sunnyvale, transgressed from outdoor demonstrations to engaging sit-ins. Workers, displaying banners and slogans such as "No More Genocide for Profit," voiced their opposition against Google's continued partnership under Project Nimbus, accusing it of aiding in activities they deem as contributing to human rights violations. The pinnacle of these protests saw a coordinated sit-in within the offices, including that of Google Cloud CEO Thomas Kurian, a symbolic statement aimed at drawing attention from the upper echelons of Google's management. In an immediate response, Google locked out the involved employees from their accounts and, following an internal investigation, issued terminations to 28 employees, citing violations of company policies, including disruption of work environment and failure to comply with internal codes of conduct. Google's stance was clear. While the company supports the right to peaceful protest, It unequivocally upholds its internal policies against behaviors it deems disruptive or harmful to its operational integrity. This hardline approach by Google towards employee protests is a critical moment for corporate governance, illustrating the delicate balance between maintaining operational discipline and respecting employee voices, especially on matters as charged as military contracts and human rights concerns. It raises pertinent questions about the extent to which companies should tolerate internal dissent and the mechanisms in place for employees to voice concerns over company practices they find unethical. Moreover, the repercussions of Google's actions extend beyond the immediate circle of fired employees. The tech giant is now under the lens for how it handles dissent and the potential chilling effect its actions might have on future expressions of concern by its workforce. This scenario also reignites the debate over the responsibility of tech companies in global conflicts and the ethical implications of their government contracts. The involvement of law enforcement to manage the sit-ins and subsequent arrests further amplifies the narrative, casting a spotlight on Google's critical decision points when internal protests escalate. From a public relations viewpoint, the manner in which Google navigates this controversy will either serve to assuage concerns about its ethical compass and employee relations or exacerbate them, impacting its brand reputation and the trust among its workforce. In a notable swirl of developments, Infosys, the Bengaluru-based IT services colossus, grabbed headlines for a series of compelling reasons that collectively sketch a portrait of a company in flux amidst the rapidly evolving tech landscape. Infosys finds itself at the intersection of strategic recalibration, a significant shift in employee dynamics, and ambitious ventures into digital engineering, underscoring a period of transformation and adaptation in the wake of technological and economic headwinds. First off, a piece of news that piqued widespread interest was Infosys reporting its headcount for the financial year 2024, showcasing a decline of 25,994 employees, marking the first ever drop in headcount since at least 2001, with the total headcount standing at 370,240, down 7.6% from the previous year. This development signals a wider industry trend impacted by new technologies such as AI and Gen AI. These advancements are driving a shift towards nonlinear growth patterns in revenue and staffing. Infosys's move away from campus hiring over the past quarters and a noticeable reduction in attrition rates illuminate a recalibrated approach to talent management in an era where technology is increasingly substituting traditional roles. Amidst these operational shift currents, Infosys recorded its highest ever yearly total contract value at $17.7 billion for FY24, with a notable 52% emerging as net new, despite the challenging macroeconomic environment. This accomplishment, manifesting amidst a tightrope walk of revenue forecasts and headcount adjustments, underscores Infosys' persistence in securing large, transformative deals. These investments are promising indicators of Infosys' enduring allure in the global IT services market, bolstered further by strategic partnerships exemplified by its notable digital transformation contract with Singapore-based Pacific International Lines. However, Infosys' financial results and forecasts bring a mix of optimism and caution. The company reported a commendable 30% jump in net profit to 7,969 crore in Q4, alongside a modest 1.3% increase in revenue. Yet, it's the cautious 1 to 3% revenue growth guidance for FY25 that mirrors the broader uncertainties permeating the IT sector, influenced by discretionary spending slowdowns and decision-making timelines extending at client levels. Central to the waters Infosys is currently navigating is its deliberate pivot towards engineering R&D and digital transformation services. This strategic inclination is vividly illustrated by its acquisition of Intech, a Germany-based engineering R&D provider with a strong foothold in the automotive industry. This move not only boosts Infosys' capabilities in digital engineering, but also signifies a concerted push into the software-defined vehicle space, marking Infosys' ambition to stay ahead in the innovation curve. The acquisition complements Infosys' portfolio with Intech's expertise in autonomous driving, e-mobility, and smart industry solutions, poised to deliver differentiated value to global clientele. Furthermore, in a testament to its strategic vision and innovative edge, Infosys continues to embrace next-gen technologies, particularly Gen AI, which CEO Salil Parekh cites as expanding their capabilities across software engineering, process optimization, and customer support. This reflects a broader industry trend where embracing generative AI models becomes a catalyst for delivering enhanced value and operational efficiencies. Yet, despite these promising strategic maneuvers and a record performance in certain metrics, Infosys has not been immune to market responses. Its stock witnessed a dip post the Q4 earnings report, a reaction emblematic of the complex matrix of expectations, realities, and forward-looking strategies that investors grapple with. Today, the tech giant Apple was under the spotlight, showcasing the riveting highs and lows of its journey in the tech landscape. From Wall Street analysts dubbing its stock as dead money, to its battle against Huawei in China, and not to mention the overall concern regarding its smartphone market lead, there's a complex tapestry of events impacting Apple at this moment. Let's dive into the multifaceted narrative that unfolded around Apple today, exploring each angle to understand the broader implications for the tech behemoth and its stakeholders. The Wall Street perspective. Starting off on Wall Street, we see a grim forecast from Maxim Group analyst Tom Forte, who suggests that Apple stock could be in for a stagnant period, dubbed as dead money. His caution stems from the tech giant's current challenges, especially in China, where iPhone sales have plummeted by 37% year-to-date. Forte's forecast isn't just a blip on the radar, it's a beacon highlighting the significant pressure Apple faces, particularly with 18.9% of its revenue tied to the Chinese market. His analysis has set a palpable tone of concern, raising questions about Apple's ability to navigate its near-term hurdles, especially with its PEG ratio suggesting that the stock may be overvalued in the context of its growth prospects. Huawei's challenge. Adding to Apple's plate is the challenge posed by Huawei with the launch of its Pura 70 series. This move by the Chinese tech titan is a strategic play in the high-end market segment, directly targeting Apple's dominance. The introduction of innovative features like a retractable camera with an adjustable aperture in its Ultra edition is a bold statement of Huawei's intention to outpace Apple, especially when iPhone sales in China are witnessing a sharp decline. This development is crucial as it signals a potential shift in consumer preferences within one of Apple's key markets, at a time when the company is already grappling with declining sales. The global smartphone market shift. Amid these challenges, reports have spotlighted how Apple lost the top spot in the global smartphone market share, ceding ground to Samsung after iPhone sales slid by 10% in the first quarter of 2024. While some might view this as a typical post-holiday season reshuffle, the deeper insight reveals a stagnating trend in iPhone shipments and revenues over the last few years. This situation posits a critical reflection on Apple's growth strategies and product appeal amid stiffening competition and market saturation. Interestingly, amidst these analyses, Apple's current predicament invites a deeper discussion on its future trajectory and investment appeal. Could this phase be a dark tunnel, leading to a brighter, innovative future, spurred by AI advancements and a richer services portfolio? Or does it mark a more troubling stagnation in a company that has historically been a beacon of growth and innovation? These unfolding stories around Apple today serve not just as a pivot in its market narrative, but also as a reflection point for tech enthusiasts, investors, and consumers alike. The juxtaposition of challenges and potential paths forward for Apple ignites a robust discussion on what the future holds for one of the titans of tech. As we wrap up, I'm curious to know what you think about Apple's current challenges and its strategies to navigate through them. Are we witnessing a temporary stumble or a deeper recalibration in its market strategy? How do you see Apple's competition with Huawei impacting its future? And importantly, would you consider Apple stock a wise investment at this juncture? Your insights and opinions are invaluable, and I encourage you to share your thoughts in the comments below. Let's dive deeper into this discussion and unravel the multifaceted narrative that is Apple's journey in the tech world today. Today's tech stock market sentiment is palpably cautious and reflective of significant scrutiny across major tech firms, seemingly weighted by a blend of operational, strategic, and geopolitical challenges. Starting with Tesla, the sentiment is one of uncertainty and anxiety. Concerns over Tesla's shifted focus toward robotaxis and away from a more affordable vehicle model have raised eyebrows among investors and analysts. Deutsche Bank's downgrade to a hold rating reflects growing skepticism about the company's strategic direction and its ambitious autonomous driving goals. Despite Tesla being at the forefront of electric vehicles and AI, its recent dip in quarterly vehicle deliveries and workforce reductions indicate a period of adjustment as it navigates market slowdowns and competitive pressures. Google's situation adds another layer of complexity to the market atmosphere, especially with its recent employee firings related to protests over Project Nimbus. The company's hardline stance against internal dissent, amid ethical controversies regarding its contracts, paints a picture of rising tensions within corporate governance and the challenging balance between operational discipline and employee rights. Google's actions, juxtaposed against a backdrop of ethical dilemmas and public relations, contribute to a sentiment of caution among investors and stakeholders regarding its internal stability and moral direction. Meanwhile, Infosys projects a mixed sentiment, blending optimism with caution. The company's reported decline in workforce, attributed to technological advancements like AI, and a refocus on digital transformation and engineering R&D services reflect a strategic adaptation to evolving market needs. However, the cautious revenue growth guidance for FY25 signifies the underlying challenges in the IT sector, underscored by macroeconomic uncertainties and client spending behaviors. Apple encapsulates the current market's dichotomous sentiment, caught between challenges and resilience. Reports of declining iPhone sales in China and lost market share globally have put the tech giant under a microscope, with speculation about its growth prospects. Yet, Apple's sustained focus on innovation, coupled with its robust brand loyalty and growing services segment, suggests undercurrents of resilience. The competitive pressure from Huawei and the stark analysis from Wall Street analysts such as Maxim Group's prediction of Apple stock being dead money paint a critical period for Apple, signaling a need for strategic pivots to reignite growth and investor confidence. The cumulative effect of these individual company narratives induces a market sentiment that is cautiously watchful, with an acute awareness of both the immediate hurdles and the long-term technological and strategic recalibrations that these tech giants are undertaking. Investors and market observers are on the lookout for how these companies will navigate through the pressing challenges, adapt to the changing landscape, and potentially redefine their market positions amidst evolving industry dynamics and geopolitical influences. Focusing on Tesla, the decision leans towards a hold strategy amidst the currents of today's news. The rationale here is multifaceted, grounded in both the immediate challenges Tesla faces and the future potentials that its strategic shifts hint at. Tesla's journey is evidently at a significant inflection point. The company's deliberate pivot towards focusing on the development of autonomous vehicles, especially robotaxis, instead of launching a more affordable Model 2 EV, is a bold strategic move that suggests a future leaning heavily towards software and services. This direction could redefine urban mobility and automotive functionality, pushing the bounds of the industry towards a new era of transportation. However, this pivot isn't without its complications. The decision has sparked concern among investors, contributing to a recent tumble in Tesla's shares. Furthermore, Deutsche Bank's downgrade of Tesla to a hold rating amplifies the unease, focusing on the inherent challenges in achieving full autonomy, a path fraught with regulatory, operational, and competitive hurdles. Additionally, Tesla's first year-over-year decline in quarterly vehicle deliveries since 2020, coupled with workforce reductions, highlights immediate operational and market challenges. Such turbulence demands a cautious approach, integrating considerations of both market dynamics and Tesla's internal strategic recalibration. Yet amidst these immediate challenges lies a canvas of potential. Tesla, under Musk's leadership, has time and again demonstrated its capacity to innovate and disrupt. The AI and autonomous driving ventures hold a promise of groundbreaking advancements that could further cement Tesla's position as a market disruptor, potentially realigning its financial and market trajectory. Holding Tesla stock suggests a balanced approach to these dynamics. It acknowledges the immediate hurdles and investor concerns while positioning for potential long-term gains tied to Tesla's ambitious, albeit risky, pivot toward an AI and autonomy-centric future. This strategy is not dismissive of the skepticism warranted by recent developments, but rather an optimistic caution grounded in Tesla's history of defying odds and redefining markets. Today's tech market saga paints a tapestry of caution and vibrance against an ever-evolving digital landscape. From Tesla's strategic pivot toward robotaxis and AI, facing investor trepidation and a hold recommendation from Deutsche Bank, to Google's controversy over Project Nimbus, leading to a significant employee backlash. Infosys showcases resilience amid workforce adjustment and strategic realignments towards digital transformation, whereas Apple navigates through turbulent waters of declining iPhone sales and stiff competition from Huawei. These stories collectively sketch a day of reflection, challenges, and strategic shifts in the tech realm, suggesting a cautiously watchful market sentiment. The unfolding narratives hint at critical junctures and potential turning points for these tech giants, offering a blend of short-term hurdles against the backdrop of long-term strategic realignments. As investors and market watchers weigh these developments, today's market activity underscores the complexity and dynamism of the tech industry, poised on the cusp of innovation and disruption. Remember, technology and market landscapes are always changing, making every piece of news a potential catalyst for the next big shift. Stay tuned, and let's discover together what tomorrow holds. Thanks for watching to the end. Remember, this is just one story from our full daily show, which includes all the other news and an analysis of the day's tech market activity. If you found this video interesting or insightful, then please like, subscribe, and share it with others. Your support is greatly appreciated. Catch you later.